In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Welcome, everybody. Merrill Chandler, your host of the Get Fundable podcast. All right, today is something that is of crazy importance for not just times of personal financial crisis or even global financial crisis. We need to understand exactly what our behaviors, how our behaviors affect a lender relationship, and what does paid as agreed actually mean. So we're going to cover a whole bunch of variations on this. Think of it as a pie, and we're cutting out slices of this pie because there are so many ramifications during times of crisis, especially in times of our global pandemic that we've had here recently. So I'll be when we come back, we'll start from the top. I'll see you in just a second. Welcome, everybody. So in this episode, we're going to be talking about what does paid as agreed actually mean. All right. And there's a number of ways for us to slice this because there are so many ways that we, without knowing, can not keep our agreement with the lender. And when we don't keep our agreements with the lenders, we're going to end up in that delinquency mode, right? So let's start from the top. First of all, how do the credit bureaus record all of this? Now, once a month, for those of you who are in the know, once a month, there's what's called a reporting date, meaning every creditor, every lender reports account status to one, two, or all three of the credit bureaus. That's on the credit account reporting date. Now, what's being reported is the status. Was it paid as agreed? And paid as agreed mean, was it paid the date, by the due time, and the amount, the minimum amount that was required? On loans, that's the loan payment. On the on revolving accounts, that's at least the minimum payment. So we have to remember that while we evaluate every one of these scenarios that we're coming up against. So paid as agreed is paid by the due date and time and the minimum amount for either loans or the minimum payments for revolving accounts. So let's take a look at a couple of things that some of our students, our clients, have expressed. Kind of when there's a financial struggle, either personally or globally, both these rules occur are in effect every single time. The borrower behavior that is being measured is, are you keeping that agreement, right? Some people who run into problems like in a personal financial struggle, financial injury, or losing a job or otherwise, they'll look for a loan or a payment consolidation. So the way it sounds is, if you go to one of these consolidating companies, they will make you an offer and say, we will combine all of your debt and we'll lower it so you make one monthly payment and we'll pay all of your credit cards. What they don't tell you until you're signing the paperwork in fine print is that what they're doing is that they are charging you one payment, but they're going to every single creditor and they're saying, hey, we want to negotiate. Our person is in hardship. So these are the words they're using. They're not telling you that they're using these words about you. And I'm not saying that they're not true. You may be in hardship, but what they're representing to your creditors and your lenders is, this person is in hardship. We're trying to avoid bankruptcy, and they cannot afford the current minimum payment. Now, right there, bracket, right there, we're telling the creditor that it's not going to be paid as agreed because due date and time and the minimum payment. They cannot afford your current minimum payment. Will you please negotiate to lower the interest and lower the amount that we are paying? Now, you do this with 2, 3, 5, 7 accounts, and sometimes, as advertised, they can lower the payments by 20%, 30%, sometimes as low as 50%. So if all of your credit, your revolving account, your credit card debt, let's say all the minimum payments equal $600 a month, they may get it around $300, $350, $400. And you're like, yes, this is awesome because I'm saving $200 a month. Here's the problem. Because you're not making that minimum payment, you are now not paying as agreed. And and every single time, there's not an exception to this, guys. Every single time, not paying it as agreed is going to show a 30-day late, a 30-day late, a 60, a 90, 120-day late. Now, what they won't do is charge off the account because you're in what I call a homegrown Chapter 13 bankruptcy. Now, a Chapter 13 bankruptcy is where we do formally through the bankruptcy courts, you do this very process, lower a payment, and then you retire your debt. But your credit is taking a crazy hard hit by being in a Chapter 13. Okay. Well, the same effect occurs on your profile. Now you have 1, 2, 3, 7 creditors that you're not making that minimum payment. And as a result, you're getting 30-day lates, 60, 90-day lates across 2, 3, 5, 7 accounts. It's going to obliterate your profile. So it's going to kill your golden goose. All right. Now, sometimes we have to do what we have to do. I'm not saying that this is that don't do this. I'm saying this is your last freaking resort. You don't do this unless you're ready to crash your entire personal profile. And as I've taught in every way possible, your greatest asset is your financial reputation. You should be selling houses and cars and do anything to protect your profile, if at all possible, especially if you're going to use that profile to leverage your way out and take advantage of whatever new, if we're in a recession, if we're in a growth phase of appreciation for homes, you're a real estate investor. If you need your credit and your financial reputation at any time in the future, you've got to do whatever it takes to protect it. If you decide to throw it all away, then one of these services can help you lower your cash flow, but in the process, you will ruin your personal credit. Now, the next thing you need to understand about this is that they're going to close the account. You don't get to keep an active account and not be paying your minimum payments. So they're going to close the account. And you're also burning the relationship with that lender until at some point in the future, you pay back all of those payments, all that amount that you didn't pay. So this credit card consolidation, guys, is the worst thing that you can do besides all the other worst things you can do. So I need you to be aware. Do walk this terrain very, very carefully. If you're a student or client, talk to your advisor team. You've got to make sure that you know how to navigate these. These are treacherous waters. They are dangerous, and you got to know what you're doing. So that's one way that you can pay where you don't pay as agreed, and it's going to kill you. Now, kill your fundability and your personal profile. Now, do not confuse this service that we talk a debt consolidation with a debt consolidation loan. And remember, so that they can get under your skin, these debt consolidation services are going to make it sound like you're getting money to pay this off, when what they're doing is they're negotiating on your behalf with your creditors, and they're lowering the payments, and you're making one payment. So be wary. This alert, alert, danger, Will Robinson, danger. You cannot be deceived by what they're saying. Consolidation services are not consolidation loans. So the next thing is that, and I'll just put this in here because it belongs. If you have a good profile and you are still fundable, you can, many times you can get a tier 1, tier 2, or tier 3 loan that's a loan and pay down the balances of your revolving accounts, so that you're literally doing a debt consolidation loan, not a debt consolidation service. Keep those separate. And just remember, I'm going to repeat myself even one more time. Debt consolidation services are a wolf in sheep's clothing. They're going to sound like one payment means that they're giving you money, and they're not. They're negotiating lower payments, and it's going to kill your profile. A true debt consolidation loan is not going to crush your profile. It's actually going to alleviate those balances in the revolving accounts portfolio, and you're going to have a higher score, and you're going to start the 24-month look-back period better off, because as soon as we can age lower balances for 3 months, 6 months, 12 months, 24 months, you're on your way to greater fundability. So, and we've talked about debt shifting strategies. We're not going to be talking about those debt shifting strategies now. So let's go into the next piece of the pie here. So that's debt consolidation as a way to not pay as agreed. Now, one of our funding hackers actually asked this question. I was going to pull it up, and thank you for weighing in, Forrest. He asked, does getting a forbearance from a lender during this pandemic have a negative impact on your fundability? So we'll start there first. Let's talk about getting a forbearance. Now, forbearance is a fancy term for delay a payment or not make a payment, and that payment is added to the end of your loan with the applicable interest. Or so there's a revolving account version, and then there is an installment loan version. We'll cover each one of those. Let's talk about installment loans. Those are your cars, your mortgages, student loans. There's lots of offers in the pandemic environment that we have experienced, are experiencing. Those individuals who are the government-backed loans were the first ones up on the docket for forbearance, meaning for a payment forgiveness or payment deferment. And what that means is, like student loans. Student loans have been put off for 6 months, up till I believe September 2020. They're just put off. No interest is being charged and added to the back end, and no payments are being required. The reason is these loans are being serviced by independent companies, but they're backed by the federal government. And so the feds are saying, hey, if we're backing them, we're going to take care of this, and you don't have to worry about making those payments. We're trying to lighten the load of the borrower out there, so that we can keep so we don't hit a hard landing as a recession tidal wave is on its way towards us. Okay, so that's one thing. Mortgages are being offered, and mortgage deferment or forbearance simply means that we're going to push a payment back. And some of the tier 1 lenders, the Chases, the Wells Fargos of the world, many of them have offered a minimum of 3 months, some even further, but you have to check who's carrying your mortgage. But they're saying you don't have to pay, and we're going to show you as current on your credit report. Now, that sounds awesome. And if you have to take advantage of it because you're trying to stay in the game and not lose your house and not go late, then you have to make that decision. But I'm going to tell you what that means. A lender, because they're being backstopped by the federal government, may say, yes, I will let you miss 3 payments, and I will continue to show you as current. By the way, bracket this as well. Do you realize that the comptroller of the currency actually suspended the mandatory credit reporting rules because so that they can actually do this? Because technically, if somebody misses a payment, it is a federal statute that they have to report you as 30 days late, 60 days late, et cetera. That there's a ramification. There are regulations. I can't say it's a statute. There are regulations for accuracy in reporting, right? Because they want to be able to trust the system that somebody misses, it gets reported that they missed. Well, they suspended the comptroller of the currency, suspended in concert with the FP, the Federal Consumer Protection Bureau, the FCPB, which was established with Obama's, I was going to say regime, was established with Obama's administration, but the Federal Consumer Protection Bureau, they suspended the requirement to report. So then lenders are safe to be able to make the offer because they're backstopped by the feds. You can see these dominoes falling, right? They've decided that they can keep you current for that 90 days or 4 months. Some have even offered up to 6 months if required, but you have to do a means test. You have to do a proof that you need to not pay. Now, that is credit reporting, right? But that's not your relationship with that lender. We got to keep them separate. Just because the federal government says, hey, I'm going to let you miss payments, and the bank is going to support you in missing a payment, and they're even not going to report you negative, does not change how the underwriting software of that lender is measuring you. It does not change it. And so this is where we, as professional borrowers or consumers, this is where we're now in a path that splits. We get to decide, and we can always make a new decision later, but I'm telling you the rules of this game. If you take advantage of this forbearance, if you do not pay for 1 month, 2 months, 3 months, lenders will remember. It will be in their it will be in their databases, and it will be in their performance data on you. The things they're measuring, they're going to know that you took advantage of this option. Now, I'm saying take advantage of it if you have to. Cash is king. If you need to keep afloat, then do so. But you don't have to do it now. Do it when you need to or must or have to, because the lenders are measuring. And this is one of those measurements that we're all learning how we show up under stress. And if a lender sees that come hell or high water, you took care of you had their back, then in every way, they're going to have your back because they trust you with their money in times of prosperity, and they will even approve you now, right? My clients are still getting new funding approvals, brand new business lines of credit, and getting automatic limit increases. It's happening right now because they're in the bullseye. We've talked about this in other FBLs. Well, and other podcasts, they're hitting the funding bullseye. They're not out here on the outer rims of the target. They're hitting the borrower, the awesome borrower bullseye, the professional borrower bullseye. So this is so important. So if you can afford it, pay every payment. Show that you can pay as agreed. Because if you can pay as agreed during these times of stress, guys, your paid as agreed is going to, it's a weird word, but it is going to bless your fundability for the next 5 to 10 years. Because in a time of stress, you took care of, you found a way to take care of them. So you think they're going to trust you more or less in times of prosperity? You pulled through the refiner's fire. You pulled through the hard times, and you did not just take advantage of free payments, right? So that is, I'm telling you, this is one of those strategies. This is one of those strategies where it is going to be a home run. And in my boot camp, we talk about how to leverage today's borrower behaviors, because they're worth, right now, every single behavior that's being measured is worth 5 to 10x for your future fundings as well as approvals today. So we just got to remember that. Now, let's talk about another section of paid as agreed. Here's the thing. If you're desperate times require desperate measures, but if you have the wherewithal to keep going in your and maintain these business relationships, then you go all in, meaning you can demonstrate to any one of these banks, guys, if you're continuing to pay, you are going to be, and your other borrower behaviors are lined up, right? We need to walk this path intelligently, but you can actually request further approvals now, because you're not taking advantage. Because I'll promise you one thing: if you have a mortgage or a student loan that's backed by that you went through Wells Fargo or Bank of America to get one, and etc., you're not going to get any more credit limit increases if you forego payments on your mortgage or on your auto loan or whatever else. They're not going to give you more money now, and it's going to be more difficult to get it later. But if you are diligently moving through these steps, and these borrower behaviors are worth 5 to 10x right now, you can ask for credit limit increases because you've been running the fundability behaviors, and you look like that bullseye borrower, right? You're right smack dab in the middle of this funding bullseye. All right, so it's time to go all in. I'll give you a perfect example. So one of the things that we did is business as usual at Get Fundable. My organizations, and we have several that are contributors to this whole fundability movement: education, fulfillment, etc. Right? And so Wells Fargo, I cut a $37,000 check from one of my business credit lines to invest in another one of our expansion things because I'm going all in. Guess what? Wells Fargo didn't have a single problem with making that transfer. Why? Because we have demonstrated in every way that now and before our behavior is count-onable. And I have the conversation with Wells Fargo. Hey, I just wanted to do this. Is that okay with you? Exactly what I talk about in the boot camp. If you haven't been to boot camp, you got to go, especially during these crazy times. You got to find out how to talk to your bankers, how to build that relationship with the bankers so you're being approved right now. So that's the third. There was consolidation, there's forbearance and deferment, those things. But also, if you're doing it well, if you're doing it right, you can ask for more money, credit line increases, and be able to create the right kind of circumstances so that you can leverage this. Now, I'm going to say this because I'm saying it every single time, just as cautionary tale. Do not make your minimum payments. Make something a little bit more than a minimum payment, because you do not want to send the message that you can only afford a minimum payment. That's on a revolving. You can continue to make your regular scheduled payments on your installment loans, your mortgages, auto loans, student loans, if you're going to keep that going, wherever you can. If it is not detrimental or harmful to the cash to take care of your family and your loved ones, then take care of your personal fundability at the greatest asset that you have in your financial world. Thank you for joining me, guys. This is Merrill Chandler. I love bringing these insights to you. I love leave comments where you can, so that we know that you're not just listening, because a bunch of you are binging the hell out of these podcasts, and I love it. But I want to know how we can serve you more. What are the questions you need? Thank you, Forrest, for sharing a question that we can dial in and drill down deeper and deeper. So, paid as agreed. It is a thing. Protect your relationship with your lenders, and they will lend to you now and in the future. This is Merrill Chandler, your host of the Get Fundable podcast, and I love it, guys. You be well and have a spectacular day.
Thank you for listening to the Get Fundable podcast. Please leave comments, because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast, because we want them to get fundable too.